participant, you were saying, hey, look at HDFC Bank. So I know that quabble is on, but yeah, no taking away the fact that we are trading it.
So you're giving Bank Nifty some credit.
No, you don't know whether I'm giving or no. I'm just saying it's great.
It'll be exciting because you've got expiry today. Global cues are once again actually fairly positive this morning. Remember, volumes globally are very, very light. So whatever moves you're seeing is on back of very thin volumes. GIF Nifty is indicating to a marginally positive start this morning. So you should see sort of a flat move. Don't expect fireworks again. I mean, we're comfortably above levels that we've never seen before. So you've got to be taking that with a little bit of gratitude, I think, in the case of bulls. Very quickly, let's wrap up what the global action is before we, walk down to what's happening locally as we gear up for trade this morning. Across Asia, trade is quiet. Australian markets have made a 2-year high. They continue to trade around those levels. Japanese markets are seeing a little bit of profit taking in early trade this morning. Wall Street, on the other hand, ended positive. Remember, volumes were less and they were quite light. The Dow itself closed at a fresh closing high. The S&P 500 closed shy of its Jan 2022 highs as well. Wall Street, remember, is striving to close this week, making it the 9th straight consecutive week of gains coming in for Wall Street since 2004. One space or one asset class that did see some pressure was the bond markets. This was largely because of a massive auction that was put out by the Treasury to the tune of $58 billion in 5-year notes. That, of course, led to higher supply in the system, which, of course, put pressure on the 10-year paper. It came in as a surprise because very recently, last week, in fact, the Treasury auctioned 2-year notes, which was snapped up by market participants and had very little impact on yields in last week's trade. Apart from that, the dollar index, that's critical to watch out for as well. Trades closer to 100 odd. And that, of course, is much lower than levels of 102, 103 that we've been witnessing in the last couple of weeks of trading. Crude below $80 a barrel. The inventory continues to rise, so that will put pressure on crude prices. So in that trading range is largely what we've seen crude at 75 on the downside and 81 to $82 on the upside. That's pretty much what we have in terms of global cues. Niraj, but I think I've been reading a little bit about what's happening globally. 74% of market participants believe that the Fed is going to cut rates in March. Most believe that we might be eating a little bit of our 2024 gains for global markets. I mean, you're expecting a massive rate cut. If that doesn't get given to the market, it's going to be a little bit of a disappointment, given that we've actually ran ahead of ourselves, at least for global markets. Yeah, and well, it's varying because Morgan Stanley, so even in India, Morgan Stanley is saying it's June, CLSA is saying it's February, so it's all over the place. Let's wait and watch how it shapes up. But interestingly, with the 10-year yield at 3.79% yesterday and oil being lower, on the global side, I don't think too many people are complaining, save for the Japanese factory output slipping. Our markets is the interesting piece right now. So the trade setup for this morning, it was essentially sector rotation, and we saw that happening when the week started. And we didn't have metals participating with as much gusto. It was chemicals and pharma, and then metals participated yesterday and day before yesterday. And yesterday, banks. So it's sector rotation essentially, which is propelling the indices to fresh highs. But the problem is VIX and the Nifty PCR are high. VIX is now at the highest level since March, and you've got to argue that with volatility being so high and the Nifty PCR being so high as well, are there some telltale signs that on the expiry day there might be a bit of a pullback? Remains to be seen. The Nifty, though breaking out from the previous swing highs of last Wednesday, technically augurs well now. Does this mean that we'll have higher highs today? Remains to be seen. I must tell you that the rollover positions indicate that people have been comfortable with what the trading positions are, because the market-wide rollovers or rolls have remained above the 3-month averages, which essentially shows that the average trader out there who's rolling over the positions is very comfortable with the kind of roll cost that exists as well. And one would presume that these are longs getting rolled over, either on the banking side or otherwise. So that is actually a very positive sign. And, we're talking of enough sectors every single day which are coming out and putting their hand up. Yesterday it was banks on the large cap side, but look at the mid cap end, Samina, and the kind of moves that happen and the kind of delivery based buying that happened in auto ancillaries yesterday. And there's a table that we have which shows the stocks percentage mark for delivery
from an Amara Raja to a GNA Axel to Munjal Shoa to Shanti Gears, some serious delivery-based buying that was seen in trade yesterday, with almost all of them, I mean, volumes marked for delivery versus 5-day average were at least 2 times, in some case even 3 times. So very strong delivery-based buying.
So
there.
Moving in line with what auto stocks did yesterday as well. So you had Tata Motors, Bajaj Auto, M&M, all of them rallied up quite sharply in trade yesterday. Niraj, we'll of course talk about this because I think this is it's a happy piece to close the year with. India, remember, has become the 4th most valuable market in the world. While that doesn't sound, if that doesn't make you happy enough, we've done the best as compared to our global peers. So if you look at the 10 top global markets, India has knocked in gains of, I think, 24%. The Dow is at about, the US is at about 22%. China is down 9%. So the housing concerns continue to worsen. Of course, the question to ask is, if we go into 2024, you've got India trading at 20 plus, while you've got China trading at 7x. It's going to be a bet of valuation, but that's going to be anybody's guess. Japan has increased 11%. France, FTSE have grown a marginal 3-4%. And Hong Kong has also suffered a big cut. So we seem to be the shining star, and it's the 5th straight year of gains coming in for India. So in terms of market cap expansion, we've done well, and historically it's consistently outperforming.
And that is so good, right? Because for passive money managers, a market of this size, you would find it harder and harder to ignore. So therefore, that's great news. But I mean, one, that is there, and 2, 5 straight years, somebody would argue at some point of time, the weight of the market will play on. But for now, the going is good.
The going is good. Also, one quick data point that we read: 7 out of 10 years in the past, January seasonally is a weak month. Now we're coming out of a very solid 2023 and even more solid December. I mean, I don't know, is the holiday season now going to get pushed to Jan, which means people will just stay off and stay on the sidelines if it is going to be weakness, but it's also election year.
And it's also the earnings
good earning, and a good earnings season.
Good earnings season, very likely, So that's interesting.
So we'll have lots to keep ourselves busy, but remember, we are going into the last 2 days of trade. You've got very little activity you'd expect. A lot of the trading desks are, of course, trading with low volumes, so market activity may be restricted or limited in that sense. Let's quickly take you through stock movers. That list also shorter this morning as compared to what we usually see in trade. Zomato is the big one to watch out for. They've got a GST notice, a show cause notice for an alleged tax liability. The notice is to the tune of 401 crores, which the tax authority believes that Zomato owes them. This is on back of delivery charges collected. Of course, Zomato has responded to that, and they said they're not liable to pay any tax on delivery charge, which is collected on behalf of delivery partners. So this is going to be an interesting one. One way or the other, the stock will be in focus this morning. Canara Bank, smaller counter, but important because they've got an in-principle approval for listing of Canara Robeco AMC on the exchanges via an IPO. The AMC came into existence in 1993. Of course, this is subject to due diligence being completed, but the stock will be in focus on back of that IPO that is expected in the near term. You've also got Petronet LNG. They've signed a pact for setting up an LNG terminal at Gopalpur port in Odisha. On back of that, the stock may see some activity this morning. But Niraj, I do think the list is much shorter this morning. I don't know if you've got lots up your sleeve.
No, just 1 or 2 more. So HUDCO could be in focus because they've signed an MOU with the Gujarat government for investing up to 14,500 crores for financing housing and urban infrastructure projects. Now, this is just an MOU. We don't know the timelines by which this would happen, but presumably, if HUDCO has got that into financing this, it helps their loan book meaningfully. So therefore, do watch out for HUDCO in the session today. So that is one stock. Samina spoke about Canara Bank because of the listing of the Can Robeco AMC. PNB is the other one in focus from the PSU banking space because there's a board meet today to decide fundraising for 2024-25. So watch out for Punjab National Bank, a successful fundraise. I mean, they'll just announce this and then the fundraise might happen at some point of time. Today is just the board meet, but typically that gets stocks excited. So do watch out for PNB. There's a lock-in period ending for Fedbank Financial and Flair Writing. So I think both of these stocks will be in focus. Yesterday, we marked that the lock-in ending did not have a material impact on stocks like Tata Tech and one more. But let's see in this case of these smaller stocks today, does it have a bit of a bearing? So watch out for both of these today in the session. And there is the Nifty indices quarterly rejig impact and the adjustment likely to be seen today. Now, as per a Nuvama alternative note, the two stocks which will see the most outflows, likely to see most outflows, one of them is Adani Enterprises, likely to see outflows of $71 million, and Larsen & Toubro likely to see outflow of $30 million. In terms of inflows, two stocks which are going to get circa $30 million worth of inflows are Bajaj Finance as well as Power Grid. So do watch out for Bajaj Finance and Power Grid as being two stocks which might see approximate inflows of $30 million. And just lastly, needless to say, the pockets which have done well recently are marked auto ancillaries. But yes, you have to keep an eye out for autos. 2 days on a trot now. Nifty Auto has had a really good run. Let's see if there is more in store. Wonder what the GIFT Nifty is indicating, by the way.
Flat with a slight positive bias. I mean, I think even if we start flat, which is what we did yesterday, but we picked up very quickly on back of what was happening globally. So it could be a slow start, but it is expiry. So there'll be activity that will pick up in the second half of trade. Very quick mention, you've got another IPO that you want to watch out for today, which is Azad Engineering. They will be debuting on the exchanges. It's a 740 crore issue in combination of fresh issue of shares and OFS. An indicator premium that this might open on is about 30 to 35%. So you're looking at a price span of 499 to 524 rupees a piece. We will connect with the management around listing time, so we will get some more dope on the counter. But up until then, we've got lots of exciting stuff on Editor's Cut.
Yeah, just before we go to Editor's Cut though, I mean, a couple of stocks, I mean, yesterday, the last few days, I mean, the MNC brokerage notes have ceased to come, but the domestic brokerage notes, wherein the coverages are getting initiated, stocks are reacting. So just mark this. I don't know if we have graphics for the same or no, but nevertheless, there is a DAM Capital note on 5-star business finance. They say the best forward momentum on compounding in store. They're initiating coverage with a buy rating. And their target price, I'm just trying to see what, I have the target price. That's about 1,000. So the potential from the current market price of an upside on 5-star business finance is about 44%. So that is one stock to monitor. Maybe you have more, but just mark one more. And that is Calcutta Electric, CESC, as the name is now. Now, Antique Stock Broking has a call there. They say it's a buy. They maintained the buy, but the target price has been hiked from 93 earlier to 150 now. They say there are major changes underway. They maintain a buy. They say they value CSC as a sum of parts, using a sum of part valuation at about 150. And multiple things they're setting up. According to them, they're companies setting up a 3 gigawatt of renewable renewable energy generation plants, which will service Kolkata and Noida circles. Chandrapur 600 megawatt is selling 70 megawatts of power in spot with an option to add 230 megawatts as well. So that adds. And 2 months ago, APR allowed liquidation of 6 billion rupees, which is 600 crores of 2019 regulatory claims, which will see further liquidations in the days ahead. So all of these put together, Antique believes that CESC could hit a target price of 150. So two stocks in the small cap or the mid cap end that stood out from a brokerage note perspective.
Also, I don't know whether you mentioned this, but cement was one space that was hugely in focus yesterday. There was a brokerage upgrade that came in from Nomura, so stocks like Shree, Ramco, Ultratech, Ambuja were on the radar. They also turned out to be your top gainers in trade yesterday. But Niraj, I'd imagine there'd be some profit taking off the table. I mean, large cap names like Ultratech running 5% on back of a brokerage report. Sector rotation, yes, but I'm assuming a little bit of weakness on those counters or some more buying.
Yeah, who knows? Also because cement, I mean, Ultratech, yesterday 5% is one thing. It has done really well from the last quarter on, which was at 8,200 to about 10,000, whatever it is right now. So fabulous moves. But yeah, that's what we're talking about. Fabulous moves on certain pockets, more so in the IPO side, and some interesting options available if you are a slightly risk-averse investor. So we'll talk about both of those, I believe. Alex, on Editor's Cut today, what are we covering?
So two asset classes. Niraj, thanks so much for that. Editor's Cut, by the way, this is where we get deeper into the headlines that you might be seeing on our platform, ndtvprofit.com, and we try and get you actionable insights. So two asset classes that we will be talking about today. One of them is bonds, like Niraj mentioned, and the other is equities. And since, Niraj, we've just heard from the National Stock Exchange that India is the most active market for equities in terms of trading, I think we should start with equities. And if you will allow me to bridge the
biases, I see, biases.
If you will allow me to bridge the two, we will also talk about the global context for bonds, which then leads into the next conversation. But then you've talked about ending 2023 with a bang in the primary markets, and we're not talking about main board IPOs. We're talking about a lot of action in the SME space.
Both, I might add, Alex. So, we're calling it frenzy in the primary markets for a reason. Now, here are some statistics. I've picked this up from various notes that have come to me and some data from the exchanges as well. So that's the culmination of this. But it's 2023 is ending with a bang. So the last 2 weeks, guys, 21 IPOs in the last 2 weeks of December, main board plus SME combined. 8 main board IPOs, 7 SME IPOs last week, 6 SME IPOs in the current week. So that's the nature of what's happened just in the last 2 weeks. Imagine you ending the year with 21 IPOs. That's quite stellar. I don't think this happened before, okay? Just the number of IPOs coming into the fag end. Because usually people say, oh, December is a boring month, people are off markets, people are not trading. Volumes are generally low, and you have 21 IPOs, okay? Now the SME IPOs, here's a statistic that I picked up from Equitas Advisory. They do something called Madness in Markets, something like that they've titled it. They say 51 of 166 companies in 2023 hit subscription levels of over 100x. Yes, these are small companies, but if a company is coming out and saying this is my IPO price, and the demand is 100 times, you got to wonder what's happening. What's 100 times for 51 companies? 12 of these 166 companies hit subscription levels of over 300 times. Guys, when did you last see this? Tell me honestly, when did you last see this?
Particularly for SMEs, and we were talking about that a couple of days back, but this figure is quite stark.
300 times for 12 companies.
Just to quantify that, IPOs have added $958 billion of market cap to the markets in 2023. Now, I don't even know how many zeros that has.
Seriously?
I'll have to write it down.
Yeah, you have to write it down for sure. Here are some examples, and I'm not commenting on whether the company is a good company or a bad company. Just purely talking about subscription numbers, okay? So there was, just using 2 names as examples, SG Logistics, SME IPO, 32 crore size, received subscription for 10,100 crores. Accent Microcell, Samina has been talking about it. It received 78 crore IPO, received subscription for 18,800 crores.
It doesn't even sound right anymore.
It doesn't sound right. And if you thought that these were the largest, look at the largest. There's a list of the largest subscriptions on the SME side. Look at this. Kahan Packaging. I had missed this, but 730 times the demand.
Wow.
Net Avenue Tech, 511 times demand. Trident Tech Labs, 502 times demand. Maltrea Medicare, 446 times. Madhusudan Masala, 444 times. I mean, just the quantum of subscription that is happening in some of these names is just outstanding.
And Niraj, Alex, what's interesting is we didn't start the year off this way.
Yes.
So IPOs started off very, very quiet. It was not being received well. There was talk about money slowing down, easy money gone for the next few years. And the last 3 months, a lot of this has changed in the last quarter of the year.
Yes.
But incidentally, and speaking about IPOs, I spoke with the fund manager of the Edelweiss recently listed IPO, and so what he was pointing out is there is seasonality clearly in the IPO market as well, and generally you start off with companies hitting the Lal Street and offering a very sweet valuation compared with peers. You hit a middle spot, and then towards the end, fag end usually of a season, you will see that you'll see companies pricing their issues at a premium to the peers. He says, and this is maybe a couple of weeks back, but he says that we haven't yet hit that mark yet.
Yeah, no, could happen. So, right, horses for courses. And just before I come to Azad, people who've come on the show in the first 2 weeks, Mihir Vora, Hiren Ved, Siddharth Bhaiya, everybody cited that one red flag or the one high frequency indicator as being the subscription in the IPOs and the madness. Like Hiren said that if all the existing companies delisted their shares and relisted them again, they would get a better valuation.
I mean, our joke in the newsroom is any of us listed ourselves. I don't even know what that would be. So, yeah, I
wouldn't bet on myself for that, but the two of you most certainly.
Very kind of you.
But just the last point, that I want to make before we wrap this piece up. Today's listing. Azad Engineering. Okay. Now the company, Sajid tells me it's a great company. He's spoken to the management. They have some deep moats around that. But here's a question that I'm asking. One, it got subscribed 80 times, so obviously there is appetite. But the question that I'm asking, look at one, the trajectory of numbers. FY21 PAT 12, FY22 PAT 30 crores, FY23 PAT 10 crores. So if anything, it's not been a steady state number out there or a trajectory.
Yeah.
More importantly, if you compare Azad with any of the other peers out there as well, the new company. It may have pedigree, but it's a new company. FY25 PAT, as per projections in analyst notes, I was looking at an Omkara Capital note, about 75 to 80 crores. If we presume that with 80 times subscription, the stock will trade at a premium relative to its issue price, the IPO price, the company was priced at about 40 times FY25. Wow. FY25, by the way, not FY24. And on listing, therefore, suffice to say, if it lists at a premium that it'll probably trade at about 50 times or 55 times or what have you. Now, this is not cheap, guys, and it is still seeing 80 times subscription, and presumably might see buying today if it's got such a very heavy subscription as well. So just the fact that valuations on some of these stocks are very, very stretched, that's the way I want to end this with.
And that's also in the markets generally, right?
Yeah.
The secondary markets, I think the only concern is that money is chasing momentum. Finding value is now...
But listed momentum with a degree of history of...
Public history.
Yeah.
So here's the thing, right? And again, Niraj, weigh in because you've seen a lot of these cycles, Samina as well. Generally, when you see bond yields globally come off, you say it's good news for risk assets, and we've seen a move of from 5% on the 10-year treasury all the way down to 3.79% overnight. It settled at 3.81%, and we've seen a over 10 basis point drop overnight in all bond yields from 5-year to 30-year just yesterday. Maybe it's a one-off. Maybe you could see some settle, some of the dust settle in the new year, but then it still bodes well, I would think, for equities in 2024.
I think just a quick one, Alex. While you saw that move coming in yesterday, it was because of excess supply.
Yes.
So remember, volumes are light, not just in equity, but in the bond markets as well. So if you hit the market with $58 billion of 5-year paper, the supply didn't get snapped up, and because of that, there was a pullback on bond yields. Exactly a week ago, there was an auction for 2-year paper, which got snapped up. There was zero impact on bond yields, and everything worked. But the fact remains that was pre-Christmas, which also means there were a few trading desks that were still working. That could be one reason. Of course, I don't know whether this is related to risk or equity, risk on, risk off. But yeah, Niraj, Alex, you both can weigh in on that. Before I talk about the a little more boring piece than IPO markets, which is corporate bonds.
Nothing much to say, but for what Alex said, that typically bond yields coming off, I mean, it depended on what's happened in the last 10 basis points, etc. Just the way it's cooled off, and some very experienced people have said that there might be a further cool off over the course of the year. In general, that should augur well for equities, yes.
All right. So, and the other thing is, of course, is when you hold corporate bonds or you hold bonds of any nature, and if you are buying them at 7.5 or 7.4% in India, if bond yields come off, you benefit.
Correct.
Simple point. Capital gains along with interest, right?
And I think for the sake of people who don't understand this bond market, because it can get a little complicated, right? All you're trying to do is you've got government bonds and you've got corporate bonds.
Yes.
Government bonds and corporate bonds are instruments that the government or corporates use to raise money from the private markets. Government bonds are, of course, safer. Unlike any other country in the world, India's government doesn't run a risk of default. So unlike the US, where states go into default, government paper in India is the safest quality paper. That's followed by AAA rated paper, which is very high quality corporates coming out into the markets to raise money from investors. Now, why we think corporate bonds may become attractive going into 2024? One, bonds have been attractive or have seen interest from participants, but that's largely restricted to large ticket sizes, right?
Yes.
Largely because these are illiquid markets.
And the face value has been large.
Execution of these bonds is tougher. SEBI in 2021 reduced the face value of corporate bonds from 10 lakhs to 1 lakh of rupees.
Yes.
I believe there's a proposal that is on the waiting, where SEBI is saying that we need to further reduce the minimum face value of corporate bonds to 10,000 rupees.
Yes.
Now, if that does happen, you have online platforms, and I've read about Zero Das Kamath talking about how they're working aggressively on ensuring execution for retail investors becomes easier on corporate bonds. Now let's also, that's of course what corporate bonds are all about, but let's tell you why this might be a space that draws attention. 2023 has been a fantastic year for equity markets, Indian, global, local, except barring China and Hong Kong, but no one's talking about that for now. With a 23-24% rally in equity markets, it's but natural you may see some volatility, some cooling off happening going into next year. If that does happen, alpha generation from these levels only gets tougher. A. B. A lot of the portfolios in the last 3 months have seen their equity allocation increase, right? So what most advisors would do, financial advisors would do for their clients is they take a step back and they rebalance their asset allocation. Simply by equity markets running up, your equity allocation suddenly has gone up by 10%, which means you need to cash out of equities to maintain the asset allocation and come back into debt. In that case, what looks attractive to you? Corporate bonds. Fixed deposits aren't going to give you the kind of yield that you're probably used to, the sort of returns you've seen in equity markets, right? So your next best alternative becomes corporate bonds. Secondly, why would corporate bonds do better than any other debt instrument? Is because system liquidity is tight currently. Banks are turning a little more risk averse towards lending to corporates. AAA corporates, the Tatas of the world, find it very easy to go to a bank, raise money and move on. It's the second rank corporates or tier 2 corporates, the IPOs that we talked about, for instance, are the ones that struggle with raising money from banks that are at a good price, right? So what do? They come to the private market, issue these bonds, and then they go out and raise the funds. Also, a lot has changed. In the last 10 years, there was always a risk of default. Now, India is a different landscape now. Defaults are not frequent. We don't see those anymore. So, of course, it becomes a safe-ish sort of instrument. Yields are better. It's semi-liquid in terms of picking up flexibility with higher yields. Yields are going to remain elevated for the next 8 months. If not longer, you will have that 7 to 8 month period. And hence, I think for diversification, this is an asset class that will be attractive.
Certainly. And just a limited point on the credit risk of generally people have, or retail investors have participated in the corporate bond space through fixed income mutual funds. There is a corporate bond fund and the credit risk fund, but incidentally, since you had IL&FS and since you had a few other situations, I won't name institutions here, but there has been a little bit of waning of interest for credit risk. People have taken duration risk and made, gains in the bond market.
I think the strategy is with a mix of near peak front end interest rates along with modest sort of disinflation that we're expecting in the year. Markets will remain volatile. Keeping those things in mind, simple strategy, right? You pick up various durations, so you get a mix of duration. In that way, you're getting advantage of the longer end yield curve. Secondly, given the uncertainty, you want some flexibility, right? So you have shorter end, you have medium end, and you have long end. So that mix gives you a good sort of piece. Apart from that, and this is interesting, of course, you both can debate on this, but I've heard a few analysts actually say that don't go out and buy bond funds. Be selective, right? Go out and do your research, figure out what corporates work for you, figure out your risk profile, and you're better off having concentrated risk, because if you own the market, there's no way you're outperforming the market, right?
Certainly.
So be selective.
You can buy so I guess what they mean is from the perspective of a corporate bond fund or a credit risk fund, and I completely take that because they buy a basket of bonds going all the way down to AA. And if you are aware of how these credit metrics work, then you can take the bet. But if you don't understand, perhaps it might be better off for you to stay with AAA and stay with
government,
the government bond.
I mean, and I think, Alex, the market is getting used to these instruments. We had the SGBs, right? There was an enormous response. I mean, if you go back a few years ago, people didn't even know what a sovereign gold bond was. So there is financialization, all that is happening, and I think this space could pick up interest over the next couple of years.
Last point, I saw a 7-year fixed maturity plan that is currently offering 7.59%, or rather target maturity plan that is offered 7.59%. So which is quite interesting, right? You're getting that right now in a situation where global bond yields are falling off. All right, there's a lot more that we could talk about on this particular topic. As you can see, Samina and I are very passionate about corporate bonds.
I just thought I'll put in a shameless plug. Mahendra Jaju of Mire put this very succinctly in the mutual fund show, so people can go in and try and
by the way, if you've got questions on how to structure a bond portfolio or a fixed income portfolio, then do send your questions to us. Hopefully at some point we'll be able to play the WhatsApp number on the screen. So if you've got questions, make sure that you send them to us on the WhatsApp number. We'll take all questions on mutual funds, in fact, and that show is live at 1:30 every market day. Do stay tuned. Lots more to talk about before the start of trade, and this is NDTV Profit.
Back with India Market Open right here on NDTV Profit. Let's take a look at the top headlines at this hour. Nifty and Sensex propel Indian markets to India to the fourth rank in the world as the market cap crosses the $4 trillion mark. New York Times sues Microsoft and OpenAI, accuses them of infringing copyright and abusing intellectual property. SEBI extends deadline for nomination by another 6 months for demat accounts and mutual fund investors. Zomato gets GST demand notice for 401 crore rupees. The company says they are not liable to pay this. The RBI allows lending and borrowing in government securities. This will help deepen the bond market by deploying idle securities. Now, let's focus on today. What is the futures and options data saying about the markets, and what are the option strategies that all of you option aficionados can take in every single day? Well, my colleague Agam does this every single day at 8:30. We're going to him about 3 minutes late. Agam, good morning. What is the data saying?
Well, in a week where we weren't expecting anything to happen, Niraj, we made a new life high when it comes to the Nifty, the benchmarks, all of them showing a lot of strength. And in fact, at the moment, we are also seeing addition, a considerable amount of addition in open interest as far as the January futures are concerned. The rollovers have picked up substantially. In fact, for the Nifty, the rollovers stand at 65%. So and today, I reckon we will add a lot more going into the new year in terms of the series. As far as the Nifty Jan futures are concerned, we have seen an addition here in terms of the Bank Nifty as well, a considerable increase in open interest towards longs, even as the underlying advances by around 1.2%. So gains overall, gains are seen across, and the Bank Nifty comfortably above the mark of 48,500. Today, we will have, along with, of course, the index futures, also the options expiries for both these key indices, the Nifty and the Bank Nifty. So as far as the Nifty is concerned, on expected lines, considering the index moved well above the mark of 21,500, sustained, and in fact closed above 21,600, we saw a significant amount of unwinding when it comes to the 21,500 and 600 calls. Naturally, a lot of the writers, the core writers around those levels were forced to book losses potentially and move out. And of course, with that, we also saw a lot of writing around the same levels, but this time it was in puts. Considering the Nifty moved over 2,600 and stayed and closed above that. Well, to give you an idea now in terms of their open interest range, well, we are now looking at a 500-point range, but it's moved higher from 21,000 to now 21,500 as the base and 22,000 as where we could potentially see a little bit of a resistance based on open interest distribution. Even in terms of the Bank Nifty, and in terms of the Bank Nifty, now we once again have a lot of accumulation around 48,000 mark. Of course, we're well above that at the moment. And on the higher end, we are still seeing a little bit more traction building in around 48,500. So these are some of the cues in terms of how things are stacking up. As far as your options universe is concerned, it is going to be an important expiry. The question is whether or not we in fact do see a lot more traction coming in. What are our market experts making in terms of these cues that we have seen at the moment? Let's get in a voice here. We have Milan and Vaishnav, Gemstone Equity, joining us on the show. Milan, good morning and thank you so much for joining in. At the moment, we were expecting a consolidation through the course of the week, but that has not happened. And in fact, we've started to see another trend building up over the course of the last 2-3 days. How are you reading these benchmarks, Milan?
Good morning, Gagan. I'm so far as taking cues from the markets is concerned. I've now started taking things with a little bit of a pinch of a salt, I would call it, because we need to look at two things. Not only for today's expiry, but even if you look at January 04 expiry for Nifty, the range remains the same. That is, we have maximum call oil build up at 22,000 and max put oil build up at 21,500, indicating 21,500 to be a very strong support as of now. Now, one thing I would like to point out that options data obviously gives us some cues about what market participants think. But at the same point in time, one must not forget that they are coincident indicators. By coincident means they are just giving you a situational awareness kind of a thing. So now, one thing is pretty much obvious that we cannot fight the trend. We have to travel the trend on the upside and we have to continue to chase the trend. But now what we need to do is to chase the up moves in the market in a little more mindful manner, because I see that the markets have deviated a lot from the mean. Talking of Nifty, the 50-week moving average is way below 2,600 points from the current levels. Coming to Bank Nifty, the 50-week moving average is way below 4,700 points from the current level. So sooner or later, some consolidation can be expected. But yes, right now, these are not the times to short the markets. We have to travel with the trend. But now we need to change the trend, as I just said, in a more mindful manner.
So don't short at these levels, certainly not. But when you go into longs, play with a little bit of caution. That's the word coming in as far as your benchmarks are concerned. But Milan, you have a strategy on Reliance Industries. If you could take us through that one.
Yes, as I just said, chasing the markets in a more mindful way, I would prefer to stay highly stock specific. Now, coming to Reliance, oil and gas space is showing very strong relative strength, and this stock per se is looking at a multi-month breakout on the weekly chart. So I expect at least 3 to 4% gains here. One can play out through options trade by buying a 2600 call, of course January call, and selling 2700 call. One would pay a net premium of 32 rupees, and this will keep the maximum losses limited at around 9,600. The maximum profit potential is around 15,000 plus rupees in this trade. However, one can keep a very strict stop loss of 25.30 on the stock. If the stock slips below 25.30, this would negate this technical view, but otherwise one can play this bull call spread in Reliance for the coming month.
Right. Milan, you know, why the difference between the spread that you're talking about and just going ahead and, in fact, buying perhaps a slightly out of the money call as far as Reliance Industries is concerned? What is the difference between taking these two positions? Why would you employ this spread and not perhaps go ahead and buy calls when you already know that the risk in both these strategies are limited in any case?
See, there are two ways you can play out this. First of all, if you take a directional view on Reliance, obviously the view is on the upside. So there are many ways to deploy this directional view. One can simply go ahead and buy naked call options, but that would have the limited loss profile, unlimited profit potential. That's fine. But if anyone is not willing to take any disproportionate risk, by entering into futures or going long in futures, bull call spreads would put your losses, max losses limited. It's a maximum loss, it's a limited loss and limited profit strategy. It's more for safer option players.
Right. Fair enough, Milan. That makes a lot of sense, of course. This is intended for those who may, in fact, want to go ahead and long futures. But if you do employ this call spread that Milan has been talking about, in that case, it certainly limits your risk to a certain extent. And, of course, in terms of multiplications, it comes down to the number of lots that you, in fact, go ahead and employ. And it will give you an effect of the futures as your futures advances. You continue to, square off that particular call spread and then move on to another call spread, and then that way you can in fact go ahead and replicate the movement of the futures too. Milan, thank you so much for joining us and taking us through your views on the markets, and we continue to track and keep an eye on Reliance Industries as well as, of course, the benchmarks. And with that, it's over to you, Samina.
Thank you, Agam, for that. That, of course, is the F&O strategies that Milan was recommending for today. Well, in the interim, the GIF Nifty, if we can just quickly pull that up before we go across and understand the other stocks to watch out for in trade. It's indicating to a positive start. Comfortably higher is what we're anticipating in today's day of trade. Asian markets, remember, are trading lukewarm. Good chance that we will be trading in a very tight range. You may even see some sort of easing off a consolidation that will take place in today's day of trade. But it's expiry, so that is, of course, one unknown that we'll be playing with. Just a quick sort of feel-good data that we've collated and the team has put together. India has gained for the 8th consecutive year. So the Nifty, the markets in India are going to close out the year for the 8th straight year with gains. In fact, we are the second strongest performance in the last 6 years. This is what we've seen this year. Calendar year 2023, the markets are up 19%. Calendar 2022, which was last year, the markets were up 4.5%. In 21 was was a seller year. Remember that year, so the markets gained 24%, and of course, so on and so forth. But it is a stellar rally that has been put forth by the Indian equity markets. We've outperformed 10 of the other global markets, to say, from the US to, of course, markets in Europe, a few in Asia, including the likes of China as well. Hong Kong and China, of course, are huge underperformers. Those are two markets that have sold off in this year. Well, let's talk about stock-specific trades, because that's going to keep us busy in today's session. Varsha is standing by with a lot more on that. Varsha, you've got Canara Bank, Petronet, PFC and Lupin that are in focus this morning. Take us through what's going on.
So good morning, Samina. So first, let's start with Canara Bank. So which has Canara Bank is yet to launch IPO of Canara Robeco AMC. Now, company has in principle approved to initiate process of listing of its mutual fund subsidiary. If you see, this will be the 5th mutual fund company in India to list. Also, modalities of listing will be decided in due course of time. And the mutual fund manages assets worth rupees 78,398 crore as of November 2023. And if you see the other listed AMCs in India, we have HDFC AMC, then Nippon Life India AMC, followed by UTI AMC and Aditya Birla Sun Life. Then next we have Petronet LNG, where it signs part for setting up LNG terminal at Gopalpur port in Odisha. Now they're going to set up 4 million metric per tons LNG terminal with option to convert it into 5 MMTPA land-based terminal. Now this will bring augmentation in overall regasification capacity in India. Also, recently, if you see, Petronet LNG signed deal to supply propylene and hydrogen to Deepak Nitrite for almost 15 years. Then lastly, we have Lupin, where it receives approval from US FDA for one of its drug, which is used to treat eye conditions. Now, this is a generic equivalent of a drug sold by Bausch & Lomb, and the estimated annual sales is almost $29 million as of October 2023 as per IQVIA.
Okay. Watch out for that. Varsha, just a quick follow-up there. From amongst all the pharma companies, Lupin seems to be the one which is consistently getting approvals, not getting very major observations from the US FDA as well. Would that be a fair assessment?
Yeah, and also, Niraj, one thing that we must see, the product launches that Lupin is into and the growth prospects that Lupin will see in following years, maybe in FY 25-26, you'll see good growth prospects in the company. So yeah, as you said, this is the right assumption to be made. Okay,
thanks for that, Varsha. Well, so that's on Lupin. If we can pull up the YTD chart or a one-year chart of Lupin, and yes, a bunch of pharma stocks have done well, but this one in particular with a 15% uptick, if I'm not wrong, and that's what the chart suggested, probably has done a very steady move. 75%, yeah. I thought 15% sounded a bit off, but who knows, I might be wrong. But yeah, this year 75%, and as you can see, much unlike some of the other pharma stocks, Lupin is at a very steady move, because I don't remember in the last 12 months having spoken on even one instance wherein Lupin has had a major observation from the US FDA for any of his plants. That speaks volumes at a point of time when the US FDA action has been heightened. We know what's happened with it's happened with Aurobindo, with Laurus, with a clutch of other names. Not happened with Lupin. Maybe with reason why the stock has done what it has done. Okay, and we'll try and get you guest views on this as well. But before that, I think the other important aspect is the brokerage notes that have come in this morning. And while there are a clutch of them that came out, let's start with Antique's view on CESC. They have maintained a buy, but I believe raised the target price. Mahima Johnson to tell us what are Antique's assumptions. Mahima, good morning.
Right, good morning, Niraj. So as you rightly said, they've maintained buy but raised the target price. So previously they had a target price of 93 and they've now raised it to 150. So it's an upside of almost 62%. Now they've based it on basically three assumptions. The first one is that the company is setting up a 3 gigawatt renewable energy generation plant, which will be servicing in Kolkata and Noida. Then the second assumption is that the Chandrapur has a 600 megawatt plant where it has 2 PPAs, one long term and one medium term, with the Indian Railways, where the company plans to renegotiate the tariffs at a higher rate for both the PPAs. And it says that if CESE chooses to play a spot there's an upside risk to EBITDA by an INR of 6 billion by FY26 as per the estimates. And they've also reported that the regulatory assets of the company has swelled to INR 56 billion, and this is a growth of 30% year on year. And it also says that CESE has placed 8.7 billion bids to acquire 100% of Chandigarh Discom, which will also help aid the growth of the company. And as per their forecast, they forecast that 5.4% of CAGR in revenue by FY26 and 26% CAGR in the EBITDA by FY26. They've also stated two risks, that are the adverse or delay in the WBERC regulatory order, and second, the capital allocation to projects earning low quality of IRR. So this is the entire summary of what the brokerage has to say on CESE.
Thank you for that. Those are a whole bunch of stocks and brokerage upgrades coming in from our research desk. Counters that will be in focus this morning. Sudeep Shah, now Deputy VP Head Tech and Derivatives Research of SBICAP, joins in. Morning, Sudeep. Thanks for joining in. Sudeep, we were expecting this to be a quietish week, but we've all been surprised. The markets rallied sharply, took out levels of 21,600 with great ease yesterday. Bank Nifty pulled its weight together, closing about 8-9% higher for the December series. How good are we looking on the index? What is the strategy for the Nifty first?
Good morning. Absolutely, what you've said is right, that it does not seem that the FIIs are on a vacation. They are really active in the markets, and that could be gauged from the way the derivative data is shaping up. If you see even the cash segment, yesterday they have bought closer to 2,900 crores. So by no means they are on a vacation. But you just see what has happened in the last 1 week or 10 days. The rally has been largely concentrated towards the large caps. So while if we see last Wednesday we had seen a fall from higher levels in Nifty, approximately 500 points. Nifty has not only recovered that entire fall and is now 50-60 points above that Wednesday's high also. And in this, all these big boys, Reliance, LT, Infosys, HUL, Ultratech, Hero, you see it, and all these large caps have really performed. But if you see on the mid cap end of the market, that index, it had a big run in the last 2 months, but in the last 7-8 days, it is just the large caps that are doing the entire, the entire momentum shift has turned towards large caps now. So I feel the large caps could continue their rally in the next week or 10 days also. And Nifty levels, I guess it's just now with every passing day, we are inching closer to 22,000 and maybe much higher than that. Overall, I feel the supports now positionally are now pegged at 21,300, 21,350, and till the time indices sustain above these levels of 21,350, higher levels of 22,000, 22,100 could be in sight. From an expiry perspective today, 21,500, 21,530 would act as an important support. A lot of put writing has happened in 21,600 and 21,500 strikes. And on the upside, the call writers are placed around 21,700 and 21,800 strikes. So that means that 21,800 for the day could act as a resistance. The bias is positive and more so towards the banking index. Yesterday, we saw a good outperformance in the Bank Nifty as well as in the Fin Nifty. So from a banking index perspective, with HDFC Bank, Kotak Bank, IndusInd Bank, and a lot of PSU banks moving, I feel it would be easier for Bank Nifty to scale 48,500 initially. So overall 48,000, 48,050 could act as a support. And on the upside, 48,500, 48,550 could be witnessed.
Right. Sudeep, stay with us. We've also got with us Feroze Azeez, Deputy CEO, Anand Rathi Wealth, joining in. Feroze, hi, it's Samina. It's been a while since we last met or spoke, but great to have you on NDTV Profit. First up, Feroze, it's the nature of the markets to price everything in advance. What are you attributing this euphoria, this inflow of money, FIs working overtime that we are seeing for our markets?
Good morning, Samina. It's such a pleasure to be talking to you again after a long gap, in fact. Now, coming back to your pointed question of how or what does the market do? Market definitely prices in advance and also prices in bad news in advance. And only when there is a difference between expectation and reality from a news, earnings, economy standpoint do the markets move. So point one is that news is going to be good and has been good. News by which I mean the continuous of the government probability went up after the 3 state elections. If you look at general elections, last 5 general elections we analyzed, general elections have been opportunities, 1-year time frames, investing timeframes, plus and minus general elections have always been a positive outcome for all the 5 times, and the minimum return has been 10 and the average return has been 16. So what happens is capital markets love continuity. Irrespective of the government, they like to have the same governance, same kind of policy making. So point is that the probability went up. That's one great news. There was a lot of money waiting outside. 57,000 crores has come in this month itself, and we've not finished the month yet. So they're working overtime. Is something which is a great hypothesis proved by this data. Second, if you look at the corporate earnings, we were expecting a 945 earnings for Nifty. That's been upgraded to 960, 964. The first 2 quarters, I think they are indicating that 960 is very, very possible. And the next year earnings are 1076. Earnings are good. Macroeconomic variables, we track about 6-7 of them, and 6 out of the 7 are in deep green. So all put together, I think market is discounting all these factors, and I think the rally isn't over. If you look at the derivative data, FI long short, which is a great proxy in terms of how much long or short has been built up, it's just 65-35 on the long side, favoring the long side, which I would expect it to have reached 80-85, which is not. So there's some more steam left.
Right. Feroze, stay with us. We'll slip into a quick break. We'll come back. We are tracking pre-open. It's expected to be a flat to slightly positive start, so stay tuned.
Back with India Market Open right here on NDTV Profit. About 2 minutes left for the pre-open rates to kick in. And we are in conversation with Feroze, Azeez and Sudeep Shah. Sudeep, we haven't been able to take your stock ideas. Can we do that? What are the stocks that you're recommending for the morning? Okay, I think you're on mute, Sudeep.
Good morning, Niraj. Absolutely. The first stock idea that I have is Deepak Nitrate. Now, we've seen the chemical space buzzing off late, and in the last, say, 3 to 4 sessions, we have seen this stock gaining very good momentum on the upside. But if you see from a positional perspective, from a medium to long-term perspective, the stock has been forming a rounding bottom pattern and is breaking out of its consolidation of last 18 to 20 months. Now, the stock is consolidated between 1750 and 2400 since May 2022. And if you see, a lot of long build-up has been witnessed in the going into the Jan series. So I feel that this stock, which has broken about 2400, which was its key resistance area, now the stock is headed up to 2600, 2650 on the upside, and the stop loss one can keep from a positional perspective for this could be 2390 on the downside. The second stock that could do well is JSW Steel. Now, of late, we have seen the metal index buzzing, and that is largely to do with the cooling off in dollar index, which is now quoting somewhere around 100.80. So I feel from the current levels, the metal space could still see some decent upside, and JSW Steel, which has hit its lifetime high yesterday, and it's now trading above all its key resistances and the consolidation zone that it had witnessed in the last 1.5 years now. So this stock could head up to 920, 940 on the upside with a stop loss at around 840.
Okay, well, watch out for these. I would love to ask Feroze about whether this uptick in metals that we saw yesterday or near term could be because of the yields and all that's happening, because the China data is not looking strong at all. So I think it's an important conversation point, but we'll do that in just moments from now. The pre-open rate's about to kick in, and we're likely to see a flattish start. The question only is that can we build on from there? As much happened yesterday when we started off quiet and then built on during the course of the day, or do we start off on a good note as well? Can banks, and HDFC Bank in particular, which had a big day yesterday, do more? Something we'll ask Sudeep about it on the show as well, but the start seems to be okay. Let's wait and watch for these rates to settle down. Feroze, good morning and thanks so much for joining in on NDTV Profit, your first show. Lovely to have you. I want to start off by talking about this whole metals resurgence that we're seeing now. Sudeep rightly says that there is a momentum out there. Yesterday the metal stocks were up and active, but the Chinese data is abysmal. Now, is this a tactical, technical uptick that is coming into some of the metal names buoyed by what's happening to yields, etc.? Or could there be fundamental reasons for the metal stock to see some further buying?
Yes, I think from a metal perspective, like you rightly said, there's momentum building up. There is some degree of bad news as well from China. But if you look at the fundamental reason, I think over the next few months, metal and all cyclical stocks, for that matter, especially the infrastructure stocks, because the government spending in the fiscal on the fiscal side has been very prudent. By this time, or the first 7 months, government ends up penetrating into their fiscal deficit to the extent of 73%, and this time it's just been 45%. So there's going to be a lot of spending on infrastructure, and I think metal gets some degree of collateral benefit from it. So I personally think that the second half of this year, which the data is still emerging, but till 7 months, we just penetrated 45%, which from the long-term average on the fiscal deficit side would have been penetrated 73%. So that's one great news. Second, I think the kind of liquidity in the high beta stocks is something which is going to play out from a technical standpoint. There are some sectors which are defensive, some are high beta sectors. When liquidity-driven market happens, there is flight of capital. When people want to take the pendulum swing on that side, high beta is a great space to be in when liquidity is chasing stocks. And especially when you look at the small cap and the mid cap names, the FII participation in those over the last 5 years has dramatically changed. Earlier, FIIs would only participate in the top 100 at best. Now, if you look at the top 10 small cap names where FIIs exposures this financial year have increased, their re-ratings have been very sustainable and they are significantly higher. So there are about 34 stocks in NSE 500 greater than 100p and about 160 of them greater than 50p, and that seems to be a reasonable buoyancy also in these re-ratings. So point is, high beta will definitely have some degree of attraction during market swings to play extra swing of the pendulum on one side, which is the positive side, of course.
Indeed, Feroze, and we've been seeing that for the last couple of weeks now. Sudeep, Bank Nifty pulled its weight yesterday, closed comfortably above levels of 48,000. 48,250 is where we were anticipating some resistance, but it looked comfortable towards closing yesterday. HDFC as well managed to gain about 1% odd in line with Bank Nifty. What are you expecting from Bank Nifty today as we head into expiry, and also HDFC, any trades there?
Tamana, see what we've seen in Bank Nifty yesterday is that during the day, initially it was just trying to consolidate around 47,950, 48,000, but steadily it pulled its weight, and we saw HDFC Bank and IndusInd Bank also outperforming, even Kotak Bank for that matter. And now Bank Nifty is not only closed above 48,250, but it has even broken beyond that 15th December high of 48,219. So now it's comfortably heading towards 48,600, 48,700 on the upside. And as I said in the beginning of the show, now the upper levels are just a number, and the rally and the momentum is really, really very strong. And if you see here, if we see Bank Nifty, Axis Bank and ICICI Bank has not even performed. So now if these stocks start performing, or they even just become market performers, the 49,000 or beyond that number is it's easily achievable. So from an expiry perspective today, 48,000 strikes have seen massive put writing. So I think any dip towards 48,000, 48,050 early morning would be a very good buying opportunity, and Bank Nifty could scale up to 48,500, 48,600 from an expiry perspective. Highest put call writers are placed at 48,500. So I feel overall the range for the day could be 48,000 on the downside to 48,600 on the upside.
Feroze, what is your take on banks? They've done nothing all through the year. Of course, there's a little bit of coming through in the last 6-8 weeks. How would you approach the banking space? And also, what do you expect from the big banks as we head into earnings season, HDFC in particular?
Yes, Samina, I think from banking standpoint, that's about 26% of Nifty's weight, banking and financial services. So that's a heavy weight which had not rallied. Of course, there is some degree of relative performance still left in these. The kind of money which chases these top banks, because they are in the top 5, 7 of Nifty, when there is money coming in, there's a lot of allocation which is happening. From an earnings standpoint, I'll just come in a moment. But if you look at HDFC, it's got the heaviest weight. So when money is being allocated, 57,000 crores, if it comes into India from FIIs, largely they are index driven. They follow several MSCI indices, and HDFC, of course, being a part of all of them, including the India domestic index, will have a larger allocation. And you also have the EPFO wanting to allocate a few lakh crores, and it has still not achieved its 15-17% target on the total wealth. So point I'm trying to make is every time India is going to get an allocation, the largest weights in the Nifty are going to be given a lot of importance and liquidity. Second is whenever the money is gone, whenever the stock goes into the hands of an FII, they are practically out of the free float. We calculate something called the implied free float. Implied free float, by which I mean all the stocks which have actually been taken away by the index funds are not going to come back into supply unless there is an outflow in the index fund itself, because there is non-discretionary kind of mandates operated by index fund followers. So point is, yes, there's going to be a technical re-rating in these stocks because there's a lot of liquidity chasing India. That's point one. Point two, I think the earnings are going to be stable. If you look at the kind of NPA situation has been controlled beautifully. Indian balance sheets are okay. Mark-to-market losses don't exist because yields in India are just about 3-4% more than what they were for a 10-year average. For example, the 10-year GSEC 10-year average is 6.82 and we are at 7.1. Globally, we have seen 200-300% move. If the Fed rate for the last 10 years is 2.12 average, we are standing at somewhere around 4. So there are going to be a lot of mark-to-market losses and some degree of accounting jugglery which needs to be done in the West to keep the banks looking healthy. But I think India has been able to overcome that because the largest problem for the globe, which is inflation and resultant interest rate, doesn't exist for India.
Feroze, I know you do this whole scientific method behind mutual fund recommendations. I'm just trying to understand, as you look forward to the sector which will do the best in 2024 according to your team's assessment and your own intelligence, what is it that you believe will stand the best chance for giving alpha in 2024? Sector, stock, whatever.
Yes, I think if I mention 3 sectors, because a mutual fund investor can't play a 15-day, 1 month kind of a game. So I'm going to give you a little more structural changes.
Feroze, which is why we are not talking on the mutual fund show. Which is why we are asking to you on India Market Open, whatever you can recommend.
Okay, perfect. So I would say the chronological order of higher probability of outperforming Nifty. I think Nifty IT will outperform Nifty by about 4-5% for this calendar year, which is just expected to open up. And then I would say cement is another sector which has the potential to outperform Nifty. Relative performance of these two sectors can throw up 4-5-7% alphas over the broader index.
Why cement though? I'm just trying to understand the fundamental reasons. Why do you like cement? And would you stick to the larger pan-India players, or do you believe the regional players would do better?
So I'd say pan-India players would do better, point one. Point two, I would say that the volume growth of about 10-12% and an expansion in the margin is expected by about 2% to 3%. So owing to these two reasons, I think the 4-quarter results of the cement sector are going to pleasantly surprise the market, and that pleasant surprise would result in some degree of outperformance which people can capitalize upon.
You're quite stunning, Samina. Cement, and we were talking about it yesterday, Ultratech being the gains that they had.
And there was a brokerage upgrade from Nomura as well. So clearly Anand Rathi is in line with Nomura on that sector. Feroze, and this is largely coming in from, I know Niraj just said that this is not a mutual fund show, but I have one very pertaining question here. I know since September we've had so many retail investors that have been waiting on the sidelines anticipating a correction. Markets at that time also did look stretched. Now, between September to now, we've seen a massive rally. There's a lot of dry powder potentially on the sidelines. There's money waiting to come in. What should those investors do? Because, I mean, it's a tough call, right? If you do think the run-up and the rally will continue, is now a good time to join the party? Are we too late in the game? What should one do?
Yes, Samina, I think like you said, there's a lot of money waiting outside. I was also of the same belief that the retail investor is outside, but in fact, the HNI is outside. If you look at the mutual fund data for this year, the SIP numbers are very, very healthy, which I think is a reasonable proxy to retail investing. But if you look at the total net flow, if you take the SIP inflow, and subtract the total inflow, which has actually come into equity mutual funds, the lump sum investments are minus 28,000 crores up to 30th November, which means that the retail is buying. HNI has been selling equity mutual funds. So HNIs have stayed out. Retail has been very, very, very strong this time. 2 years back, it was 11,000 crore SIP number. Today, it's about 17,000 crores, and the markets did nothing till October 2023. Markets for 2 years did nothing. So point is, retail is inside. HNI has been trying to time the market, and they've gone horribly wrong. If they have gone horribly wrong, I would still say that there is a fundamental reason for one to buy. If their expectation is 11 to 12% Nifty growth over the next 4-5 years, I think that's par for course, and 3-4% alpha over and above Nifty is possible if you can microscopically choose about 8-10 fund managers from the 150 to 153 available. So to answer your pointed question, they should jump in. They should jump in with an expectation of 8-10% correction at all points in time, because the last 22 years say that markets show peak to trough. So, but they should not stay out. They should come in. And I think this rally is not just liquidity driven. Fundamental and economy variables are also very, very strong. So it's not just liquidity which has chosen to move the market.
Okay, well, point well taken. By the way, the pre-open rates have settled, and I think they have settled well. So before we take in the top call from Sudeep, let me quickly get in my colleague Himansh to give us the rationale that DAM Capital has put out for their buy rating on 5-star business finance. The stock is up about 1.5% in the pre-open session. Himansh.
Thanks, Niraj. DAM Capital has just initiated their coverage on the small finance lender, which focuses primarily on the tier 3 to tier 6 cities, lending to small business owners as well as self-employed individuals. What the company really highlights as the key strengths for this company going forward are, firstly, there's limited to negligible competition, which ensures pricing power, also gives in visibility in terms of profitability as well as margin expansion in the near term. You have what really plays out here is SARFAESI tools that are a key barrier. The inability to use them makes this lender's expertise in this area over the past 2 decades really stand out in terms of competition. They expect to see productivity inch up by 25%. They also see the debt burden ratio of 50% or less better off than the long-term average of about 38%. The potential for current management team to also scale up the business is looking well in terms of their commentary with branch expansion plans for the next year. They also have a very robust capital adequacy ratio of 59.4%, so they don't see the need for dilution or fundraise in the near term. ROAs could possibly, however, come down from the current levels, and business has the potential for higher multiples, so you will see some potential re-rating coming in perhaps in the midterm. They have set a target price of 1,000 rupees on the counter, implying a 44% upside potential from the current market price.
Right, thanks, Himansh. 5-star Business Finance is a stock you would want to watch out for in today's trade. We've got literally 2 minutes to go, Sudeep, before we go into market open. One top call.
One stock which I feel could do well in the next couple of days is Dalmia Bharat. Now, we've seen cement stocks making a move in the last several sessions. So, Dalmia Bharat has been in a tight range in the last 6 to 8 months, but in the last 4 or 5 sessions, it is slowly showing a good build-up from 2200 levels. And with all these stocks, Ultratech, Grasim, all the other top stocks moving, I feel now this is a very good quality mid-cap stock, and I feel this could do well in the next few sessions. So this can be bought with a 2250 stop loss and a potential target of around 2450, 2500 on the upside.
Okay, so top call for the next 2 days is Dalmia Bharat from Sudeep. Sudeep, stay on. We'll take in your opening thoughts plus market open. Feroze, stay on as well. Would love to just talk about a couple of other fundamental things before we let both of you gentlemen go. But about 29 seconds left for the markets to kickstart trade. Keep in mind, we'll also keep an eye out for, like Himansh said, 5-star Business Finance, but CESC, because I think that has also started off well in the pre-open session after the move yesterday. Antique as a buy call, the target price is about 150. So watch out for CESC2 in the session today. That's the other stock that should be on everybody's radar. But the market's about to kickstart trade. The pre-open session was, well, let's see if the markets are actually moving in line with the pre-open had suggested. The start is about 1/4 percentage point in the green, 21711 for the Nifty. So strong start there. The Bank Nifty about 1/3%. I wonder if HDFC Bank is participating yet again, but about 1/4% for the large caps, and Bank Nifty is higher. Nifty mid cap about 0.37% higher. Small cap index will also come up on your screen about 0.5%. So the broader end of the spectrum is really shining in trade today as well. Let's pull up the heat map and show you what's moving and what's not, and what's the breadth looking like. So just about 6 stocks in the red, majority in the green. The top loser is iShares with a loss of less than 0.5%. Tells you how it is looking. But the gaining side, JSW Steel, a top call from Sudeep, up another %. NTPC is higher, Tata Steel is higher. So metal stocks certainly up and about in trade. There is strength in BPCL. I don't see HDFC Bank in the top 10 list, but ICICI Bank is certainly there. So when you have HDFC and ICICI performing, it's very rare that the Bank Nifty will correct, and which is actually a good part. HDFC Bank is lost somewhere in the flatline list, but the ones worth talking about are metals. Yet another positive day in trade for them. And NTPC, which was the top loser yesterday, about 1.5% higher in trade. Well, Samina, that seems to be the order for the large caps, but the activity in the mid caps a lot stronger.
I don't have CSC on the list, but that stock, Niraj, as expected, 3.5% rally on CSC is what we have in opening trade on back of the brokerage upgrade. Couple of names that are on back on news that has come in. You've got Hudco. They've signed an MOU with the Gujarat government for investing 14,500 crores for financing housing and urban infrastructure projects. So watch out for that one. The stock should be seeing some momentum in trade today. Zomato, now this was the big story post-market closing yesterday. They've, of course, received a show cause notice from the tax authorities where they owe the tax authority over 400 odd crores for delivery charges collected. The company very categorically has stated that they're not liable to pay tax since delivery charge is collected on behalf of the delivery partners. PNB, that's a banking name to watch out for. They've got a board meeting to decide fundraising plans for 2024-2025. Talking about fundraising, Canara Bank has approved the listing of its subsidiary Canara Robeco AMC via an IPO. This member was set up in 1993, so the listing has been on the forefront now for the last couple of months. Lock-in is ending for a few anchor investors for recent listings. You've got Fedbank Financial and Flair Writing, so you can expect a little bit of supply coming into the markets as some of these anchor investors have come to an end of their holding period of 1 month since listing. So those are largely the names to watch out for. for Niraj, but I guess there are some more in the broader markets that you're probably picking up on.
Yes, that's had a good start, of course, 2.5 to 3% higher, so should pull up that stock on the brokerage note, and also on Antiques View, 3% higher, in fact 130, and should also pull up 5-star Business Finance and see if it's had a good move at the start of the trading day. It had started off about 1%, excuse me, still about 1%. I wonder if Sona Comstar is up another 2.5%, if I'm not wrong. Remember, this comes on the back of a very strong move yesterday, now 627 at all-time highs, if I'm not wrong, for Sona. Hindustan Copper is up about 4.5%, so that one is having a good day. Something that has had a really good run the last few sessions is Castrol. I wonder if the belief about how not coal coming back is a reality, is that not all cars will be EV, and therefore, the likes of Castrol will do better business, is playing out here. But seriously good move the last few days for Castrol, so that is to be watched out for as well. But it's not all hunky-dory. And just quickly mark maybe a couple of losers in the session as well at the broader end of the spectrum, because the gainers list is thin really. Losers, Zomato, and I think 1.5%. And my colleague Hiral tells me that while they've said this, there could be repercussions, because the GST Council would have a say back too when Zomato makes its petition that we are not necessarily liable to pay this. And lastly, something that was up and about, by the way, a few stocks that are up and about the last few days, Samina. 3M India was up 14% yesterday, down about 1.5%. BDL is down about 1.5%, and Balaji Amines is down about 1.5%.
I'll take you through a few gainers while he's highlighted the three losers this morning. Some of the metal names are still doing really well in trade. So broader market, mid-cap metal activity is stocks like Hindustan Copper, 4.5% higher this morning. You've got Jindal Stainless, which we've already talked about, and a couple of other names that I'm trying to pull out. JSW Steel, Jindal, of course, from the frontline stocks are doing well. But generally speaking, metals continues. Nalco's also having a good run, 1.5% higher on the counter. Quick mention on the three IPOs that listed yesterday, if we can pull those up, because they did start off quiet but went home with very solid gains. So happy forgings, if I can get that one on the screen. RPZ Jewels started off very weak, but another 5% added in today's day of trade. Happy Forge building on that rally from yesterday, 1% higher. And Credo Brands, this opened with a gap down but finally went home with gains of about 10%. Another 3% added to Credo Brands in early trade, Niraj.
Yep. Okay. Opening thoughts then from our experts. Sudeep, to you first. It started off on a good note. Are you initiating any fresh trades on the Nifty Bank, maybe a JSW Steel, or maybe a Dalmia Bharat?
Absolutely. See, on Nifty, we've seen in the first 5 minutes, Nifty has slowly built on to its opening gains, and I feel that steadily it's headed towards 21,780, 21,800, because now sustaining about 21,700 would force all these call writers who were heavily built in 21,700 strikes to shift to either 21,750 or 21,800. So I will this short covering move itself will take Nifty up another 50-70 points on the upside, and any dip towards 21,700, 21,730, 21,720 zone would be a good buying opportunity, and one could keep a stop of 21,650 for the same. So the range ideally now from an expiry perspective would be 21,650 on the downside, and it could be 21,800, 830 on the upside. From a Bank Nifty perspective, since it's sustaining above 48,500, I feel this could still continue its upwards momentum up to 48,750, 48,800. And the supports now, looking at the put writing data in the first 5-6 minutes, it could be around 48,300, 48,350 on the downside.
Couple of stocks worth mentioning. KPI Green is seeing a big up move. It's up over 6%. The stock was soft in trade yesterday. The news that's coming in is they've commissioned a solar power project totaling 17.35 mega MWP. Apart from that, Nifty Pharma, which had made a recent high just day before yesterday, continues to make a fresh new high. Gainers are led by Natco, Lupin and Pfizer. All sectors are in the green. The Nifty comfortably trades about levels of 21,700. Niraj, Feroze, I want to come to you on this one. Last couple of months have been about momentum play, right? Finding value has not been, one, it's not been easy, and second, it's not actually done exceptionally well either. If I had to ask you for the next foreseeable future, so for the next medium term sort of outlook, Is it momentum or is it value?
Samina, I think there's been a lot of smudging between momentum and value over the last 3, 4, 5 months. So I would say I think the game over the next 6 months is going to be not as generic as it could have been about a year back, 6 months back. It is going to be very specific. When you look at indices, the kind of dispersion in valuation itself is enormous. There are some stocks which have lower free float. So the variables I'm going to track to build a portfolio, if I were to build one today, I would look at low free float, high FII holding, and high domestic holding. That's one big hygiene check on any stock which is greater than 40p. If these are not in place, then the 40p or 45p, if I'm simplistically putting p as a great measure in terms of fundamental valuation standpoint, if these three are not in place, then there's going to be a lot of fluidity with respect to the current valuations they command, whatever be that variable, PEG, PE, or PB. Whatever be the fundamental valuation parameter, these are three hygiene checks. That's point one. Point two, I think the momentum play largely, if I have to answer your question, would be one thing which I would play around with, because over the next couple of months, if you look at a couple of two indicators which have a great lead indication capability, are two of them. One is the future rollover cost on a month-end basis. If you look at January rollover cost, are the highest I have seen over the last 24 months. Nifty is rolling over at 175 rupees to 180 rupees, which is a 9.5% cost of carry, where the cost of carry in terms of the treasury bill as a benchmark should be 6.25%. But there is 9% rollover. That implies that the futures market bullishness is available for one to see. And the second is, just take today's futures with today's spot. It is quoting at 22 rupees higher. The futures is quoting at 22 rupees higher, which implies that 4 rupees is the intrinsic value of the premium for a day in India as per interest rates, but it's quoting at 22 rupees. So today is going to be buoyant. Next 1 month, I think the market participants are very, very bullish, is what the future roll cost on expiry day I would like to highlight.
Feroze, I want to talk about a sector that was once the favorite of investors, and I'm talking about specialty chemicals. 2-3 years ago, this was a very expensive space, but up until now, it seems like the pain is not yet over for the sector. But we did see early this week where there was some buying that was returning to the specialty chemical space. How are you looking at this sector? Do you think 2 more quarters and the long-term outlook now once again becomes fairly bright on back of strong demand from India and the refrigerant demand as well seeing a pickup?
Yes, I think fundamentally there seems to be a turnaround, but what's happening is you make money when you buy a bottomed out sector. Like you rightly highlighted, it's one sector which a person should keep on the radar. But if you look at the last quarter results, every time the results are not good, and if the stock bounces a couple of % on a bad result, that is a great indication for any sector of a bottoming out situation. So I think chemicals is going to give that, if not already. Over the next couple of months, you will be able to find out if there are bad results, not great results, and still the stock bounces back. And I saw some indication in the last quarter. I think decisive proof of that hypothesis will happen after the December quarter results. So I can't put my foot down and say it's a good sector today, but I think a month more of information is needed for me to decipher that, Samina. So not qualified to comment at this stage.
You know, Deepak Nitrite, for example, is Sudeep's top call. So Feroze may not have a fundamental view there, and I appreciate that. But Sudeep has a buy call on Deepak. Just wondering, Sudeep, a lot of these stocks have moved really well in the recent past. Is Deepak Nitrite the only one, or do you like some of the others as well?
If we see this chemical space in the last 4-5 sessions, even Bharti Industries, Fine Organics, Balaji Amines, Gujarat Fluoro, Nosil, all these stocks have really made a big move, and they've come out of this consolidation. So this is actually, if you see last 1 year or 18 months period, they've done virtually nothing, and they're just coming out of that consolidation zone. And with the markets being so buoyant, I feel it's just every week you'll get some or the other underperformance performing sectors from now on to start moving and start at least becoming market performers, if not outperformers. So I feel Deepak Nitrate, Fine Organics, Bayer Crop Science, then Balaji Amines, Gujarat Fluoro, all these are quality names and they have not done much. So from here on, I feel these could play a big catch up on the upside.
Okay. Well, certainly watch out for that. Sudeep, we'll take a moment to thank you for joining in today and giving us your thoughts. Really, really appreciate your time. All right, viewers, so that's the view on the trading side, and a lot of stocks, of course, have done very well. But just the last one or two questions to Feroze. Feroze, a lot of 2023 has been a year of a lot of newer sectors getting created. Now, I don't know if you're at a liberty to talk about what stocks within those sectors come to the fore or no. I leave that choice to you. But between railways, between the resurgence of defense, between the EMS stocks, and there are some 9 or 10 listed plays now in that pocket as well. There are a clutch of newer themes out there for investors, or older themes which are now come back very, very strongly. Out of these set of themes, which one do you like, if at all, and why?
Niraj, I would stick to a theme which I understand a little better because of being a part of the financial services. I think the asset management companies, if you see them distinctly different from other financial services, because they're basically lending businesses like banks and NBFCs, asset management companies is a zero capital need or negligible capital need kind of a business, unlike the NBFCs and the banks. I think that sector today has 4 stocks, and like Samina highlighted, Canara is also planning a listing for its subsidiary, which is the asset management company. I'm reasonably bullish on this sector because we have about 40 odd AMCs. I'm sure the top AMC like SBI is not listed today, but I'm sure SBI Bank will look at listing it. So that's one sector which you start building your familiarity with, and you have 4 stocks today. I think that those are high ROE businesses and they're fee-led businesses, and I think the kind of India play they will get because of the financialization. I think that's one sector you should look out for. India has about 670 lakh crore of household saving, out of only 11% is in equity, and out of which only 4% is in equity mutual fund. If there's a 10% capital move from the debt instruments, which we are very heavy on, and real estate and gold, this sector will benefit immensely because there's no variable cost to managing more money, and the operating leverage has become a huge leverage for a company to show PAT growth, which is greater than the top line growth.
But Feroze bhai, the problem that a lot of people say is that while this story of the asset value moving higher and therefore your money at the same operating leverage coming in more, the yields are getting compressed by every passing quarter, right? If you will, if not every passing year. Is that not a hindrance?
Yes, it is. I'm sure, like you rightly pointed out, Niraj, why your analysis is perfect. It's about both those counter forces. Will the tailwind or the headwind will win in this case? I personally think, of course, the yields will compress from a perspective of the commissions and what they leave behind. As SEBI, as a regulator, has been quite clear that the consumer should get the cheapest deal. I think with economies of scale, those needs to be passed on. But I think still what happens is the kind of quality of assets. If an asset management company has 5 lakh crores and is managing 2 lakh crores in debt and liquid and ultra, that's a different ball game. Now, what is happening is inside an asset management company itself, the equity share is going up because you also have a God's gift in terms of market movement. If you're managing 1 lakh crore and if the market is up % today, then you straight got 1,000 crores without having to work for it beyond the management of that money, which you had to be done irrespective if the market goes up or not. So because that has a 8-10% growth potential, by the virtue of time, other sectors will have to plan for a 0 to 25% growth, but this sector can start with 10% because God's gift is 8-10%, which is time value of money if invested rightly.
Feroze, thank you very much. It was great to have this conversation with you as we head into the holiday season as well. Have a good last few days to the year, and we'll speak to you and see you soon next year. In the meantime, we'll take a quick break. Gensol has been one of the top performing counters this year and is in focus this morning as the company is looking at raising funds on January 1st. Anmol Singh, Jaggi, MD at Gensol Engineering will join us.